Today, we're diving into one of the most important secrets of smart investing. We're talking about building a portfolio that doesn't just grow, but that can actually survive and maybe even thrive when the market gets a little crazy. We're going to break down the powerful strategy of diversification into simple, actionable steps you can actually use. All right, so let me just ask you this right out of the gate. Think about where your money is right now. Are all your investments kind of piled into one or two things? Maybe a couple of stocks you're really excited about? Or maybe it's all in the tech industry? Look, that's a really common way to start, but it's also a strategy that's hiding some serious risk. I mean, you've heard this saying a million times, right? And there's a very, very good reason for it. This isn't just some quaint, old-fashioned advice. It's literally the foundation of smart investing. Putting all your money in one place is a huge bet. So today, let's talk about the strategy that's specifically designed to protect you from having to make that bet. So if putting all your money in one spot is the big risk, how do you protect yourself? Well, you build a financial shield. And that shield has a name you've probably heard before: diversification. Yep, that shield is diversification. And at its core, it's a pretty simple idea. It's all about spreading your money across different kinds of investments that don't all move up or down at the same time. Think about it. When the economy gets shaky and stocks start to fall, what happens? A lot of people rush to the perceived safety of gold, and its price goes up. So if you own a bit of both, one can help balance out the other. That's the real magic here. It smooths out the journey and lowers your overall risk. You know, a great way to think about this whole thing is to imagine your portfolio as a well-stocked toolkit. I mean, you wouldn't try to build a house with just a hammer, would you? Of course not. You need different tools for different jobs, and believe it or not, investing is pretty much the same deal. Okay, so let's look at some of the main tools in that toolkit. On one side, you've got things like gold or silver ETFs. And an ETF is just a basket of assets you can buy like a single stock. Their main job? Stability and hedging against inflation. Then in the middle, you have broad index ETFs, which are designed to just give you the return of the entire market. And then on the riskier end of the spectrum, you've got individual stocks, which offer the potential for much higher growth. A truly resilient portfolio is going to have a smart blend of all of these. But we can go even deeper than that. Just inside the stock or equity part of your portfolio, you need another layer of diversification. This means not just buying different stocks, but buying stocks in companies of different sizes, large, medium, and small. It means spreading your money across different sectors so you're not all in on tech or all in on healthcare. And finally, it means looking beyond your own borders and investing in international markets too. So, what's the perfect mix for you? This is so important. There is no one-size-fits-all answer here. The way a 25-year-old should invest is going to look totally different from how a 60-year-old should. It really all depends on where you set your personal risk dial. And what's the single most important factor that controls that dial? It's time. It's your time horizon, basically how many years you've got until you think you'll need to start using this money. Honestly, this one factor is probably the biggest driver of your entire investment strategy. And this chart shows you exactly what I mean. If you're young and have decades ahead of you, you can afford to take on more risk for a shot at higher growth. So having 70 or 80% in stocks could make a lot of sense. But as you get closer to retirement, your focus shifts. It becomes more about protecting what you've built. So your stock allocation might drop to a more conservative 40 or 50%. See? Your timeline really dictates how much risk you should be comfortable with. Want a super simple, practical way to get started? Okay, here's a classic rule of thumb that I just love for its simplicity. Take the number 110 and subtract your age. That number you get is a rough guideline for the percentage of your portfolio that you might want to put in higher growth things like stocks. Now, it's not perfect science, but it is a fantastic and easy way to find a personalized starting point. Now, let's talk about managing expectations, because this is crucial. You'll hear that historically, a diversified stock portfolio returns somewhere between 7 and 10% a year. But, and this is a big but, that's before inflation eats away at your purchasing power. After you factor in the rising cost of, well, everything, a more realistic number for your actual growth, your real return, is probably closer to 4 or 5%. That's the number you should be thinking about for your long-term plans. Okay, so we've covered the what and the why. Now let's get to the how. It's time to turn all this theory into actual action. And I've got a simple 3-step plan you can use to get started right away. Step 1 is assess. Just be honest with yourself. What are your goals? How old are you? How much risk can you stomach without losing sleep? Step 2, allocate. Based on that assessment, you choose your target mix. Maybe it's 70% stocks, 5% gold, you get the idea. And finally, step 3, and this might be the most important part, rebalance. At least once a year, you look at your portfolio.
If your stocks had a great year and now they're a bigger piece of the pie than you planned, you sell some and you use that money to buy more of the other assets. This forces you to do what is so hard for investors to do on their own: automatically sell high and buy low. It's disciplined investing.
So, as we wrap this up, I want to leave you with one final question to think about. Is your portfolio built for just one season, like a long, sunny summer of a bull market? Or is it built to withstand all the seasons, the fall, the winter, and the spring that follows? Because that's what diversification is really about. It's not about chasing the absolute highest returns. It's about building something strong, something resilient that's ready for whatever the market throws at it. That's how you build durable, long-term financial health.